Hey everybody, welcome to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by Jeff Santoro, the voice of the people. You know, I realized, Jeff, we've been calling you the voice of the people, and it goes back to when we had 7 listeners.
Yeah.
I don't think most people know what the hell we're talking about.
I think it was just because I don't know things. I think that's the genesis of it. It's like, here's Jason, this investor, knowledgeable person about stocks. And then here's Jeff. He's just an average guy.
Okay, voice of the people. It is time for a new episode. And this is more of a Stocks Unscripted episode, something that we've talked about doing before. We've done 1 or 2, and it's been a while since we did it. So we're going to talk a little more stock focused than we normally do.
Yeah, the other 2 Stocks Unscripted episodes we did were about specific stocks, but this one is going to be a little more wide ranging. We're going to talk about a bunch of different stocks, not spend a lot of time on just one, but we're going to frame it around stocks that we own that are working as investments or not working as investments, or working as businesses or maybe struggling as businesses. It's not a deep dive into our portfolios, Jason, or any 1 or 2 stocks. It's more of here are the interesting things in our portfolio and what we're thinking about them now. I think that'd be a more interesting conversation than just one stock.
I think so. And the other was Costco, and that was back in December. So it's been a while. And then the spring was when we did the trade desk one. Those are short episodes, 12, 15 minute long episodes. So this is going to be one of our normal weekly episodes. So it'll be kind of that longer form, but we also want to talk about how the stocks fit in our portfolio strategy and how they provide upside, and also thinking about portfolio management, all of those kind of things too. So it's going to make sense within kind of the greater context of a lot of the other shows that we do. The working title right now is What's Working and What's Not Working.
Yeah. And that's meant to mean a lot of different things, right? Because a company can be working as a business and not working as a stock, right? As an investment, as something that goes up and to the right. And the opposite can be true. You can have a stock that is, maybe its stock performance is overperforming its business performance, which is, we have a couple in that bucket that we're going to talk about today too. So yeah, we're going to try to come at this from a bunch of different angles. Before we do that though, Jason, we have not been promoting the mailbag much lately. And I want to take a second to just remind everyone that once a month we do a mailbag episode. We did skip August, partially because of vacations and things, but we're going to get back into it here in September. And y'all can send us questions at any point, email, social media, carrier pigeon, doesn't matter how you get them to us. We take them, we keep them. We have a few in the reserves for the September episode, but if you have a question you want us answered on the show, go ahead and send it to us. And Jason, I'm going to offer something new to our listeners.
Well, I mean, you just did. You offered up carrier pigeon as a way to get messages to us.
That's true, but I have a different, yes, carrier pigeon works, but I have another option. If you want your question to be read, but with your voice, if you want your voice to appear on the podcast, send us an audio file, record something on your phone, make your question short, don't make it like a super long one, and email that to us, and we will put it into the podcast and you can hear your voice on the show. So that's a new, interesting way for people to get questions to us.
Yeah. As Shankar Vedanta says on Hidden Brain, record it in a quiet place. No, the hell with that. Record it in the busiest Starbucks you can find. While you're standing at the register, but you haven't paid for your order.
Yeah. And I'll say this because we say it all the time. The best way to make sure that your question appears on the show is to creatively find a way to insult us in your question.
Oh, that's the best.
Yeah. All right. So where shall we start, Jason? Do you want to start with the stock that you think is working as an investment, or working as a business, or not working as an investment, or not working as a business? Where do you think we should kick this off?
So what we decided to do, it's easier for me because my portfolio is, the vast majority of it is individual stocks that I'm picking. Jeff, versus yours, where only a smaller portion of your investments are self-directed, not, index funds, that kind of thing. So what I decided to do was look at my portfolio and say, okay, so what are some of my biggest winners? Of course, names like Mercado Libre come up, Shopify come up, stocks that I've owned for, particularly in the case of Mercado Libre, I've owned for a very long time. I've bought it on the way up, as David Gardner has taught so many investors over the years with companies like that, averaging up. But also there's some other companies in here that are large cost basis investments for me, but they haven't necessarily done as well. So I wanted to include those because it's very representative of where my money has gone. And it's an opportunity to talk about what's worked there and also what hasn't. So I think the fun place to start is to talk about the winners. So these are a combination of the stocks are working, the stocks are going up, but also the businesses in the case of the ones that I want to talk about. I don't know, you've got a couple to talk about that.
Yeah.
The stocks are working, the businesses might be working, but not as doing as much heavy lifting as the stock would necessarily have you think.
Yeah. I have a couple certainly that I've been thinking about lately because they've shot up to the top of my portfolio. And while the business results have been good, I can't help but think to myself, have they been this good? I'm not so sure. You want to start with those or do you want to start with one of your winning stocks?
Let's start with Mercado Libre. There's so much content out there about Mercado Libre. It's easy to find and learn about. So I don't want to spend a lot of time talking about it. I've talked about it a lot, so I don't want to spend a lot more time talking about it. But I do think it's one of those that to me is so representative of the grander scheme. When a stock works great, this is what it can look like.
Right. What's interesting about it for me, like thinking about it as an investment, just not even talking about the business, but just talking about how the stock is done, is it's like you, it's one that I've added to multiple times over the course of the few years that I've owned it. I've bought it as the business has continued to do well. And it's one of those stocks where I've bought at a higher price multiple times, but actually at a better valuation a bunch of different times. It's like the perfect example. We talk about that a lot. You can buy something that where the price is actually higher, but the valuation is actually lower. And it's a winner in my portfolio. It's beating the S&P 500, like the total weighted average of all the times I bought it. But it still sits there as one that I'm compelled to add to again, because it's currently at a cheaper valuation than all the other, or not all, but the average times I bought it in the past. And that doesn't always happen. It's not often that they're simultaneously winners, meaning they beat the market and you can consistently buy them at a better valuation point. But that seems to be the case, at least in my experience with Mercado Libre, which is interesting.
I'm actually looking in my 401k right now, like in the 401k at Mercado Libre, looking at the times that I've bought it in that particular account. So we also own it in my wife's rollover account. I own it in my Roth. It's in my son's Coverdell account. So it's scattered all across my family's wealth footprint. And the first time I bought shares was in April of 2014. I paid $85.80 a share. The stock trades for $2,380 a share today. That's a 27 bagger, right? I didn't buy shares again in this particular account until 2021. I paid $85 a share, almost $86 a share in 2014. In 2021, I paid $1,446 a share. And then in 2022, I added again at $682 a share, $683 a share. So what's interesting is looking at the business across these, paying three very different prices at different times. The stock was obviously a massive, massive winner between 2014 and 2021. But then between 2021 and 2022, stock was a massive loser, lost more than half of its value at one point. And it's a key thing for me around Mercado Libre and why it's such a good example. You talked about it. You can pay a higher price and get a better valuation. And that certainly happened. That 2014 investment, the business was a decade old at that point. It wasn't a tiny little business, but it was still very nascent. It really hadn't jumped into payments at all. They were still focused on the e-commerce part of the business, figuring out how to figure out the payments business. And then the payments business has really driven like the past decades. By 2021, though, the payments business was about the size of Mercado Libre, right? The revenue, the dollar volume that was happening for payments off platform were about as big as dollar volumes that were happening on Mercado Libre, right? So that fintech business had really, really kicked up. And from 2021 to 2022, again, the stock price fell substantially. The business was still doing extraordinarily, extraordinarily well. I was lucky enough that I was able to realize that investment in March of 2021 was during a period of extreme market exuberance. and I wasn't going to throw the baby out with the bathwater, and I wasn't necessarily looking to buy the dip, but I was recognizing an opportunity in a business that was continuing to win. From 2021 to 2022, Mercado Libre grew revenue of somewhere around 40%, right? Was doing extraordinarily well. The growth rate of the payments business was probably 50% faster. The lending business was really starting to ramp up and accelerate. The credit card business that they do for consumers and also the lending they do to merchants, all of those things were really starting to accelerate. If you look at every e-commerce stock, Amazon, Coupang, all of those were down. Tech stocks broadly were down. Everything growth was down from 2021 to 2022. So I saw an opportunity to add, and that's done extraordinarily well, right? Again, $682 a share in May of 2022. The stock's roughly 4x that today, 3.5x, 250% return. So that's 3.5x returns. Now, what's changed though, all of these things are working. The risk profile's changed for the business. I think that's one of the things that's so important, Jeff, when you own businesses over long periods of time. And I'll be honest with you, a decade is not a really long period of time, but for a business like this, they're in 17, 18 countries in Latin America. There are lots of risk factors, and the business has evolved, and the risk factor of the business has evolved. The same way that if you look at Amazon, its risk profile is different today than it was in 2004, 2005, right?
Yeah.
So not just blindly throwing more money at a winner, expecting it to continue to win, but understanding how it's evolved and what is the opportunity and how is it changed the opportunity and the risk profile.
Yeah. And just to drive home the point that you were making about previous buys, like when I first bought this stock, it was in September of 2020. And that's when I was a baby investor and I was buying like $50 worth of things at a time, just taking tiny bets. But that first purchase for me was $968. Today, the stock's around $25.60. And sorry, no, $23.81 is where it is about right now. But just to make the point I was making before, and I'm going to use price to sales only because that's what I happen to have in front of me at the moment, but it traded for about 17 times sales then at $968, right? Today it trades for closer to $5. And the stock is up, a couple $1,000s since then.
Right.
So it's just one of those now, but I like what you said at the end there. You're not just blindly adding to winners because the stock has gone up. One of the things that impresses me about Mercado Libre is just how insanely consistent they are. I mean, their revenue growth has been not like rock solid consistent, like where it's the exact same percentage every single quarter, but for about 2 years, it's been between mid 30s and low 40% revenue growth, just consistently, always within that little band, growing earnings per share, becoming more cash generative, basically all of the metrics you'd watch on the commerce side, right? Like items sold, items shipped, and then the fintech, monthly average users, total payment volume, like everything. It's just double-digit growth quarter after quarter after quarter after quarter. And, to your point about the risk profile, you and I have talked a lot about that, the issuing credit cards and that credit risk. I'll say one of the reasons I like listening to their earnings calls or reading the transcripts is they're pretty transparent and they get a lot of analyst questions about the credit risk. And they answer them, for me at least, every time in a way that makes me feel like they know exactly what they're doing. It's not that the risk goes away or that it can't blow up on them, but they say things like, when we see it's working, we'll do more of it. And when we see the risk profile tip in the direction we don't like to see, we'll pull back on it, right? So it seems like they're being adaptive to the conditions on the ground and making decisions accordingly. I'm glad we started with this one because I feel like it encompasses so much of what we believe in as investors. And then here's like the example in both of our portfolios of the benefits of adding to winners, the benefits of finding great businesses that continue to perform quarter after quarter, the value of knowing why you own a business, knowing what metrics to follow, listening to earnings calls, reading 10Ks, reading 10Qs. Mercado Libre is almost the poster child for that process and that way of investing, I think.
Yeah, I think that's right. And I want to contextualize from that first investment to now what this looks like in terms of returns. Today, the stock fell 3.8%, almost $93 a share. It fell more than my cost basis on my first investment. The inverse of that is that next time the stock goes up 5%, it's going to be a spiffy pop, right? It's going to go up by what I paid per share for that first buy.
Yep.
And this is where you get life-changing results, right? Is when you find businesses like this that you deeply understand them over time as well. And you're not just following that number on the screen. You build enough conviction in the business and understanding of the business that the movements from day to day are less concerning.
Yeah, I mean, this has just been, I'm looking again at, I've bought Mercado Libre 20 times. And granted, some of those were very small, as I said earlier, like $50. Yes. And of those 20 purchases, only 3 are not beating the market. One of them is my most recent purchase in June, and that's just short time frame. And then there's one from November of 2020 and one from April of 2021, which kind of makes sense because if I was buying at that point, I was probably buying at peak valuation for a company like Mercado Libre.
Right.
And they're winning, they're up. I didn't lose money on them, but just trailing the market. Just those 2 purchases from late 2020, early 2021. So
one more thing. And I know it's getting to the point where now it starting to sound like I'm taking a victory lap, but I promise you, we're going to spend enough of this show of me talking about mistakes and money lost to put me back in my place. But my 401k, this is 5% of my portfolio. It's one of my largest holdings. In my wife's rollover and her Roth, it's 5% and 6% of those 2 accounts. My Roth, I was telling you about this earlier today, Jeff, it's 29% of my Roth. So as much as I have large portfolio, around 100 stocks that I own, this one stock represents, call it 7 or 8% of my invested wealth, mine and my wife's invested wealth. The winners concentrate themselves. It's remarkable how that works.
Yeah. All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, which one do you want to hit next?
All right, you got a couple on here that I think are interesting. Do you want to talk about Lemonade or Upstart?
Let's talk about both of them because I think in my mind, in my portfolio, they kind of go together, and I'll say why, and then we can dive into each one individually if you want. But I own Lemonade and Upstart for basically the same reason. I think they are disruptive companies in their space doing interesting things that I'm not really, or I never was really expecting to be huge winners really quickly.
Yeah.
You know, in the case of Upstart, I love the fact, I like what they're doing. The idea that they're helping people get credit where traditionally they would not be able to is a nice story stock thing that I like. And you and I have been talking about Upstart as it's struggled over the past couple of years. I mean, now it's doing very well more recently, and how they're going to be impacted by the credit cycle. But you always made the point, we need to see them get through a credit cycle. They've been through the boom and now the bust, and we need to see how they come out of it on the other side. So I always looked at that investment in my portfolio as a long-term hold, right? Like, I'm cool if this doesn't turn into anything for another 5 or 10 years. I just like the potential. I like what they're doing. Even through their tough times, they were really consistently winning new business, like making new deals with auto dealerships and banks and customers that are going to use their product to help people get credit. And Lemonade, in the same way is disrupting the insurance business. Tiny, tiny, tiny piece of the overall insurance world right now, doing interesting things, trying to change the relationship between customers and the insurance company, doing some good things along the way. But again, a lot of work to do, right? Like for a while, their loss ratios were over 100%. They were losing money and still growing really slowly and not profitable and all those kinds of things. And again, that was in my mind a 10, 15-year investment, right? They are nowhere near the Geicos and the Progressives and the other big insurance companies you see all the commercials for. They're just not anywhere near that in what they're able to do right now. So I always viewed those two as being long-term. I can wait, I can be patient. And then lo and behold, over the past couple months, they've both shot up to the top of my portfolio in terms of returns, just absolutely going bananas. And I'm happy, right? I've made more money. But on the other hand, I'm thinking to myself, maybe this is not reflective of really how they're doing.
So starting with Upstart, I think because I've got exposure to both Upstart and Lemonade, and I was very big on, I went too big too soon on Upstart. I was really excited about the business and what they were looking to do, particularly with their use of artificial intelligence. A little bit with their B Corp thing where, they share a portion of profits with charities that customers pick. And the idea that, and they talked a little bit about it, like that this kind of changes the incentives for customers to not exaggerate claims and things like that because they feel like they're stealing from their charities, and also creates more incentive for the business to be responsible. But also the way they've kind of built the incentives throughout the entire business to reduce the company's reliance necessarily on like float and trying to keep money that needs to pay for claims. So like changing those incentives is part of it. But one of the things is that the way they're using AI that I think should drive efficiencies. I'm getting kind of tired of my insurance prices going up, and I got an email about auto insurance. It's going to go up like another 20%. So I decided to go on Lemonade and check it out. And they asked about doing a bundle thing, and they're not doing auto where I live now. But I'm like, yeah, I'll go ahead and do the homeowners thing. And I got as soon as I put the address in, I got a note that said, like the next screen that said, there's extreme weather events in your area. We would not be able to begin an insurance policy until this date based on verification of certain things. So one of the things they talked about is like internally, they have AI that's monitoring weather data and other things like that so that they can very quickly turn on and off availability just to reduce the headache of people trying to start policies for claims that happened before they had insurance, right? So just like little things like that.
There's a hurricane 6 miles away.
I mean, that's like an obvious big example, but like their ability to fine tune that in ways that AI is doing it and not meteorologists that are on the payroll. So things like that they're doing that, and other ways they're using AI around origination and quoting that they've struggled with, right? They've struggled with those things until the past year and a half or so, when they really started saying, look, our gross loss ratio is going to start improving. And basically they started doing it, right? They were delivering on it. And all the other AI stuff seems like it's working pretty well. Paying claims, quoting customers really fast, the operational stuff that they say they can do, that a lot of those things, frankly, are harder for big legacy carriers to do because a lot of them are like bolted together like Frankenstein's insurance company, where they've made acquisition after acquisition over the years, and they have all these subsidiaries running on different systems and processes. And before you even start thinking about from one state to the next, insurance is state regulated. And that's the reason the insurance industry kind of grew up the way it did, where there's a lot of there were local state focused insurers that are now part of these big national carriers. So anyway, all that to say, like with Lemonade, I was really excited and I bought way too much early, and it was brutal when their losses worsened and they were way off their targets on their loss ratios. But the business has really delivered exceptionally well over the past year. The growth rates are good. The gross loss ratio is better. But like to the point of what's working and what's not working, Jeff, as well as the stock is done, they still have a negative combined ratio, right? Their insurance premiums are not covering the costs
And
of
they
their
don't give you
entire-
the combined ratio. You have to do some third-party research to get it,
Yeah.
which is a little bit frustrating.
Right. And like they report this like adjusted cash flow that's, I do not like that metric. Like I think it's like a bad adjusted metric to be giving about cash flow. So it's one of those things where it, again, is the business working as well as the stock would have you think?
It's interesting with both of these because as I look through all the purchases I've made, again, it's the same story, right? When I bought Lemonade and Upstart in 2020 and 2021, it was like $10 here, $50 there, $25 there. This is when I was taking like my monthly allotment, which was smaller than it is now. And I was spreading it among like 10 different things, right?
Right.
All of those positions for both of these companies, anything I bought in 2020, 2021, down 90% to the market, down 130% to the market, down 63% to the market, just absolutely getting crushed.
Yeah.
But because I watched the businesses, gained conviction, saw what they were doing, I would say in both cases, maybe 70 to 80% of what I own, I bought in the last 3 purchases, right? So the last couple of years. So for example, Lemonade, I bought a good chunk in December of 23. That lot of shares is up 170%. And I don't know that the business is 170% better than it was a year, almost 2 years ago. And it's the same story with Upstart. I bought more recently, and those are up 190% to the market, 107% to the market, wiping out all of the little tiny buys I bought that are down triple digits. But yeah, these certainly feel to me like there's some exuberance priced in that I don't know that even as the businesses had to have done better over the last year or two, I don't think the price is really warranted. So these are interesting from that standpoint. Like progress, I agree with everything you said about both companies, like making progress, heading in the right direction. But like the reason they're up so much in my portfolio is sort of like the dumb luck of when I bought the biggest portion of them.
Yeah.
Versus the bad luck and / inexperience of when I bought all these little amounts back when they were super overvalued. So let me ask you this question though, because this is now my dilemma. I believe in adding to winners. I believe in following companies and buying more as conviction grows. I have higher conviction in both of these than I did, let's just say a year ago. But now I'm in my own head about the run that they're on. I'm price anchoring a bit. And I did add to Upstart not that long ago. I took a little bit of a bite in the last couple of weeks on that one. So I put my money where my eyes are, I guess. But it is something that I think about when I see these big run-ups of stocks over short amounts of time.
So what I always come back to with that, because it's so easy to price anchor. It's so easy to get caught up in the momentum, and fear and greed comes in. Those are those two big emotions that at the end of the day, when it comes to our financial decisions, fear and greed are doing the heavy lifting almost all the time about what our guts are telling us to do. And you can train your analytical muscles, right, to like optimize your fear and greed instincts, right, to put the brakes on the ones that are unhealthy and to really grease the skids on the ones that can help you do well. And I think the key thing comes back to me, that it comes back to for me, is not looking at what the stock's done over the past 6 months or a year, and then looking forward over the next 6 months or a year and thinking about what that could mean. Like, what are the implications, right? If you have one bad quarter and you can lose half your gains, right, pretty quickly. But looking at the size of the business today, the size of the opportunity, how much of that opportunity do I think it can get, and how long do I think it's going to take for the business to get there? And then just overlaying that on top of my investing timeline. And where does it match up? Because the risk starts to go away the more time you have to let these stories play out. So like with Lemonade, what they're saying, and I tend to believe it, is that they're choosing to invest in growth, customer acquisition, right? They're willing to pay a premium right now and dedicate more of their cash flows to acquiring customers. And insurance is one of those industries where you're acquiring customers for decades, right? If you're good and you make those customers happy, and they start out with you with renter's insurance, right? And then they get auto insurance, and then they have a family and they want a house and they buy a house, and then you got their homeowners, and you collect that, you pay that cost to acquire that customer one time, and you get a premium from them every year for the next 3 decades, that's a winning strategy. So they're really leaning into trying to take as much share as they can. And this is a business that could easily, 10x the size of their portfolio and still be tiny. I mean, they're like $1 billion insurer right now.
Yeah. And I know that this is the most optimistic take on the business, right? But the idea that the reason I have, Geico and you have Progressive or whatever, I don't know if that's what we have, but just like 45-year-old guys, we have the insurance companies that have been around since we can remember owning and having insurance, right? And also the companies you see on commercials, like literally every time you watch anything on TV, Progressive, Allstate, Farmers, all of the jingles, all of the commercials. And the optimistic take on a company like Lemonade is, let's say they do really well at capturing younger millennials and Gen Z. Maybe that's the type of insurance company they grow up familiar with. That's the hope, right? Like that they are the new guard of insurance where it's easy, it's on the app, there's AI, it's fast, there's no claims friction. Maybe there's that donating the excess premiums to a charity aspect that attracts a different type of consumer. Maybe you see more companies follow in their footsteps. Maybe the next generation of insurance is more like Lemonade and less like Progressive and Allstate and Geico, right? Yep. That's the most optimistic take on their business. But I don't even think it needs to be that rose-colored glasses for this company to do well over the long term. To your point about having such a small part of the market now, right? If they can just carve out a nice niche of like, we're a little different and some people like that, they can do well. And I think I'm willing to own a little and keep track and watch it, even as it goes. It's pretty volatile. It goes up and down, seemingly not completely based on the fundamentals of the business. But yeah, these two, I think together, that's why I bucket them in my brain. They sort of live in the same space in my portfolio.
I want to talk about Upstart for a little bit because I think it does deserve a little bit of time, because I think there's a lot of misconceptions about Upstart, what it is, what it has to be successful. As a starting point, there's the idea that it has to be like this FICO destroyer. And I think that's a little overstated. FICO's become the industry standard products across all kinds of different lending products, right? They have different flavors of FICO for different things. It's over 4 decades at this point for a reason, because it's good and it's predictable and it's useful. And they've started to incorporate more and more of the things that Upstart is incorporating into its risk assessment model, right? So it's already starting to affect the biggest player in the market. What we've also seen from Upstart is that it started to establish itself for an important lending niche, and that's for credit unions. It probably has 75 or 80 credit union partners now that use it, because those are kind of like these smaller organizations that they don't have the money for the tech stack. So Upstart brings its technology that helps them as well. Top of the funnel, the online platform where people go and apply, right, for this personal loans. And then the banks can decide whether or not they're going to originate that loan, right? If they don't want it, Upstart still has other choices where maybe they use one of their investing partners that buys these loans wholesale to originate it. That's not something FICO's ever going to do, right? FICO doesn't want to build a tech platform for originating and making credit decisions and then deciding maybe they're going to buy the loans and bundle them and sell them to an investor, right? That's just a business that a lot of other banks do, right? Other lenders do, but Upstart doing the origination, the assessment, providing that tool, the technology stack for a lot of lenders is a differentiator that doesn't require the demise of FICO to be successful. So I think that's another important thing to remember too, is that lending's a giant. I mean, there's a reason there's thousands of banks and thousands of other different lenders out there that are involved in this.
Well, I think I like that point about both of these businesses, right? I made it for Lemonade, you're making it for Upstart. They don't need to be the winner in their space for these investments to work out.
Right.
Because the space that they operate in is big enough for multiple winners. But I think both of these stocks, not the companies, the stocks have become, I don't want to say meme stocks. It hasn't ever gotten to that point, but they do certainly have their loyal following in the online social media investing world.
Mm-hmm.
And I think that gives the perception to other people who see that the expectation is that they will dominate, right? That Upstart will kill FICO and that everyone will have Lemonade insurance and no one will use Geico anymore, because they've gotten sort of caught up in some of that craziness. And that's why you see these stocks go up triple digits in a year, right? 6 months, right? Which is just not normal growth. And I feel like we'd all feel differently about both of them if they were a little less on the radar and traded
Right.
a little less volatile. But that definitely is, for me, like plays into how I think about both of these.
Yeah, that's fair. They're in a very different place on their continuum than a Mercado Libre is.
Right. Yeah. All right. I want to go in a different direction. I want to come back and talk about maybe a bank in a minute. And I know we're not going to go too long on this episode, but one that I can't stop thinking about in terms of like the stocks that are absolutely not working out and businesses that face super headwinds, but I actually am bullish on over the long term, and we don't talk about this one a lot, is Moderna.
Yeah.
And I'll admit, I bought this at the worst time, right? I bought Moderna like during the pandemic when everyone was getting their vaccinations. And who knows, I can't go back in time and remember exactly how much I was influenced by the present versus like the future. But as I owned it and I followed it pretty closely, I still own it, even though it's down 60, 70% in my portfolio, because over the long term, I really do believe that mRNA vaccinations and therapies, which is what they specialize in, are going to be more prevalent. Like, I just believe that. It might take a new administration in Washington to get there. So it might be a rough 3.5 years here at the minimum. But because this company got on our radar because of the COVID vaccines, people think of it, I think, as being a much more further along and established player in the biotech space than it really is, right? I think people, because of its name recognition, think of it in the same, like it's a J&J or a Merck or a Pfizer or something like that. And it is not. It was a company with no commercial products until Operation Warp Speed, and then it had one.
Yeah.
And until very recently, it still just had one, like newer versions of that one, right? Updated boosters for the COVID vaccine and things like that. And now there's one more product on the market right now, and a few that are coming in the next year or two.
And it's barely the one that's on. So here's context. Second quarter revenue, $100 million.
Yep.
That's the context here.
Yeah. But again, like, I don't think people would be thinking that was weird if it wasn't such a recognizable name because of the pandemic, right? That's
Right.
where I think there's a disconnect here. But I feel like of all the stocks we've talked about, at least for me in my portfolio, for like where I bought it and when I bought it, it lives in its own little space because, again, I don't think I'm going to hold on to these shares until, I don't know, 2030, 2035, 2040. Yeah. Like, I'm fine waiting that long. Like, I think it's going to be a rough couple years. Like, I'm curious if they're going to be able to even sell enough COVID boosters to not have to eventually take on more debt or sell more shares or something. Like, they have a pretty good cash pile because of the couple years of the middle of the pandemic. And that's helped them along. But this is one that where I would say, like, in terms of like what's working and what's not, I would say the stock's not working as an investment, but I think the company is, like, they're making progress, and they do a pretty good job of updating their pipeline every time they report and things like that. It's going to take a long time to get all these products to the point where they either do or don't become commercially viable, right? Like, they got to get through all the phase 1, phase 2, phase 3. But I still have high hopes in this company, even if they're a decade away.
Context here, it's about a $9.5 billion company that has $7.5 billion in cash, right? So that's how negative the sentiment has become. And it's not just on Moderna, it's across the biotech space, especially for these companies. I don't want to say it's pre-revenue, but it's kind of almost gone back full circle to being back to that largely still pre-commercial. I guess they've got a, remember what it's called, but there's like a respiratory virus vaccine.
Yeah, they have an RSV vaccine that's out too.
And their RNA vaccine is coming. It's in phase 3. It's
and
close.
It's like they also have a flu COVID combination one.
Combo. Yep. Yep.
And I know that there's another one that's close for CMV, but that's like it's like a rare a rare thing that not a lot of people have. So like, I think even when that comes to the market, if it does, it's not going to be like the kind of thing like the blockbuster that turns things around. But, they have a respiratory vaccine portfolio, and then they have, they're doing some cancer work in conjunction with whoever makes Keytruda. I forget which pharmaceutical company they're partnered with. I want to say it's Pfizer or Merck, one of those two. But that's what I mean. Like that's further away, right? That's not like coming to market in 2026. That's a couple years down the road.
You're talking about the melanoma one that they're working on. I hope that their norovirus vaccine works, because there are a few things more miserable than the norovirus. But to the point, the market's basically saying we think their IP is worth about $2 billion, right? Considering this is a business the market thought was worth, I don't know, was it $50 billion at the peak, maybe more? It's pretty remarkable. So I would put this one in like it was worth over $100 billion. I forgot how insane it again. To me, I would put this one in like it's complicated bucket, because
like our Facebook relationship status in the early 2000s.
Exactly.
It's complicated.
Well, because we know mRNA treatments work, right? We saw it happen in real time. It saved millions of people's lives. There are things coming, but those things have yet to generate meaningful financial results. And until that changes, and maybe this flu season, well, next flu season really, because they're still in phase 3. Next year, when we get into flu season, we could really see some of that financial engine kick off. So
yeah. And, talk about running towards fires or like buying companies when sentiment is low. And I'm not saying it's a buy right now. That don't construe it that way if you're listening. But
I will tell you, I think it is. I don't really talk a lot about this industry because my wife works pretty deeply in it. But this is one of the businesses that I do think has gotten exceedingly attractive.
Well, because we literally have a health and human services secretary who's like anti-mRNA specifically, like that technology he does not believe in. So you could see for as long as RFK Jr. is in the government, like this, who knows, what does the regulatory regime look like? But again, that's if you're a decades long investor, if you're holding a stock for 10, 20, 30 years, that is hopefully theoretically a short-term headwind. And I just think that could really push the share price down in a way that's disproportionate to what's actually going on with the business. Sort of like the opposite of what we talked about Lemonade and Upstart, right? Maybe with their improvements, they're not quite as good as the stock performance. And I think maybe with Moderna, they're not anywhere near as bad as the stock performance.
That's right. All right. We want to pick one more here to wrap up.
Let's do for the last couple of minutes here. Let's do Live Oak Bank shares, because this is one that I was very excited about. Again, it's one I've owned and followed a really long time, but really other than 3 times I bought this in 2023, every single one of my purchases is losing to the S&P 500 significantly. And so going back to April of 2021, that's when I first bought shares. And I most recently bought more about a year ago, August of 2024. And every single one of those, except for a couple, like I said, in June of 23. One time in June of 23, everything is losing to the market. But I still really like the business. Like it's one of those where I look at the results every quarter. Things are heading in the right direction. I like the management team. They're very fun to listen to on the earnings call, very straightforward, honest, transparent answers. But I got to be honest, like your conviction in this company is higher than mine is only because, you can say, oh, I'm a long-term investor as much as you want. But when you hold something for going on 5 years and it's not really done much for you, it's hard. It's hard to see through that. Now I'm holding my shares. I might buy more. I'm not going to get rid of it. But I'd be lying if I wasn't like, maybe this is never going to turn it around.
Yeah, this is a great example of another. It's been complicated, but I think it's less complicated than maybe we think. And it's more about businesses that operate in cyclical industries and how things can go not great for years at a time before they suddenly go extraordinarily well. So part of the story with Live Oak Bank has to be the pandemic, because just like with Moderna, this is a business that was printing money. And in Live Oak's case, because their motto is, to be America's bank for small businesses, there are a few banks that know the SBA loan process as well, and that also have the nimbleness of being a small bank that Live Oak has. And that was really, really important, because during the pandemic, all those payroll protection plan loans all those things, those were government-backed loans that were forgivable loans. It was free money, and they were paying like 4% interest. And banks also had access to free capital. So basically the government's like, you're a bank, you want to borrow some money? Oh, no, don't worry about paying us interest. It's fine. Oh, we have this program to give other free money to businesses. We'll pay you interest, like 4%. Can you do, you could do, oh, and they don't have to pay you back. We'll forgive it. We'll forgive it. And like these guys were experts at that, and they were printing money. They were absolutely printing money. And as a result, the stock went to the moon. It got very detached from like the kind of financial results it could generate like in a not weirdo time, like the pandemic. Right. And a lot of people bought the stock during that period, right? Which sucks because a lot of people bought a great business at a ridiculous price that is going to just be really, really hard for the business to earn in a reasonable amount of time, like 3 or 4 or 5 years. And then interest rates skyrocketed, right? So that's another not great thing for banks. Bank lending's been tough. Small businesses especially are really sensitive to interest rates. They're also really sensitive to inflation. Right? They're also really sensitive to complex things like tariffs, right? Like, so all of those, it's just like a series of unfortunate events, for lack of a better way to.
That's the reason I'm still holding my shares, right?
Yeah.
It's like, I used to make this argument with PayPal, right? Like that going back before the pandemic, PayPal never really went through a normal time, right? It was entwined with eBay. It was being, there was the spin out, and then that went right into the pandemic. And then that was right into the ending of the pandemic. And then that was right into like, we're a super app. And then it was like new management. No, we're not. Oh, and I feel like Live Oak, for the time I've owned and followed it, is sort of the same thing. Like you said, like there's the pandemic, there's the after effect of that. They're unique in the sense that they're so tied into SBA loans and the government aspect of it. Yeah. And then the interest rate spike. So I'm willing to stay patient on this one as well. But it's another one where, when I look at the results every quarter, like just as a quick example, this is the last 5 quarters growth, year-over-year growth of loans and leases originated, right? Going backwards from the most recent quarter. 30%, 73%, 45%, 64%, 36%. That's good. Total loans and leases, total assets, total deposits, consistently in the mid-teens to low 20s, every single quarter after quarter after quarter for the last couple of years, right? Like the banky stuff is heading in the right direction. Things you want to keep an eye on with something like Live Oak. Revenue growth, not as hot. Profitability. But again,
it's the lending to small businesses. It's a tough environment, right? That's exactly right.
But all of the bank stuff is where you want to see it, right? So again, it's one of those where I keep verifying like what the stock is doing against what the business is doing. And I keep saying like, it's not lining up, but I think the market's wrong right now. And I think that eventually they'll figure it out. That's kind of where I am with Live Oak.
And one thing I come back to though, that is net interest margin is great. It's well over 3%. It's a lot higher than you see a lot of the big banks, but their returns on assets and equity are not great right now. It's less than 1% ROA and about 8% return on equity in the most recent quarter. So those aren't great, right? We want to see those certainly start to trending better. But to me, like the simile here is Axos Financial, back when it was B of I, Bank of Internet Holdings. From like 2013 or 2014 through like 2017 or 2018, there was a 3-year period where that stock just could not go up. It was super volatile. It was up and down and up and down and up. And it was a tough ride. And I know it rattled a lot of investors out of it because the returns were okay. Growth had slowed. There was a short attack and like all these accusations were flying around about things they were doing that were illegal. None of that came to anything at all. And this is another like 10-bagger stock over the past 15 years because it's this little sleepy compounder that just keeps getting bigger and better and does the smart banky things good. And I think we're going to see the same thing because you have a disciplined, very well-run institution that knows what it's good at and just does that. And I think over the long term, it's going to work out.
Yeah. That's what I'm hoping for. All right. Before we run, if you guys enjoyed this episode, do us a favor, share it with someone that you love or share it with someone that you hate. Either way, give us a 5-star review on the podcast apps, a review on Apple Podcasts. Check out our YouTube channel. Check out our newsletter. Check us out on social media. Check out our Savvy Trader. Check out our Patreon. We got a lot of stuff going on. It's all in the show notes. We'd appreciate any additional support you guys can give us.
Next time you're in the bathroom and just need something to do, just open an episode, open up the show notes and start reading. It'll take you through your mission. I promise you.
All right. On that note, let's wrap this thing up.
All right, friends, as always, these are our answers to these hard questions about investing, stocks we love, stocks that don't love us back, and more. But remember, it's up to you to find your answers. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.